Okay, so I wanted to make a short video that goes outside of the textbook material that just talks about the thing that's almost on everyone's mind, which would be the shorting that's occurring in the equities market. And even if you have no idea what it is, you may have just heard about it very briefly as like GameStop. But really, I want to talk, I think it provides a great opportunity to really talk about what is going on. And then we can, if this was an in-person class, we could obviously talk about it much more extensively, but well, I guess we have what we have. So I'll at least give you the theoretical understanding of what's going on. And at least you can say, I took this class and I learned this. So let's look at it. So we're going to use Bloomberg to look at this. This is going to be something that in the next week or two, you'll start to be exposed to this. But this is the equity portfolio for GameStop. So GameStop, basically, if you wanted to buy video games, this is your place to go. And just they're small. It's a relatively small sized shop, and these shops are in big malls, outdoor malls, indoor malls, that sort of thing. And it's a dying business. I mean, quite frankly, it's like most of retail stores. If you don't somehow make it an experience and they're selling a pretty standardized commodity, that store will have a difficult time surviving, right? So in retail, the only way you continue to exist is you either have an exclusive item or you have an item that really requires a touch and a feel, right? So like Best Buy. Best Buy thrives, even though they sell a commodity, but they thrive in part because either you've got like those audio visual like geeks and weirdos that will like walk you through exactly what you need, and or you want to touch the item before you buy it and you want someone to walk you through how to set it up, things like that. So Best Buy exists, but GameStop, pretty much, right, people know what game they want and you're really just buying the game. You're not sitting there, maybe you can try out the game, but the games are pretty expensive. So it wasn't like there was a lot of there wasn't a lot you could really do to make that experience distinctive. Okay, 1 second here. I just have to pause my video 1 second. Okay, I'm back. Sorry about that. Okay, so let's go back again to GameStop. So again, a dying equity, which, I mean, if you're on the hunt for high growth stocks with high growth potential, or even if it's not growth potential, at least stability, GameStop would not come to the top of your list. In fact, like most other retailers, like Macy's, I don't even know if right. Well, I don't even think. Sorry, I'm just trying to even see what's even out there in that landscape still. Macy's, I think, is still exists. Yeah, $14 a share. I remember 3 years ago about that it was about $30 a share. I don't even keep track. I mean, there's a lot of stocks where I have a general sense of what the current price range is, but about 2 years ago was the last time I even looked at what its share price was. Yeah, it's about right. 2018, it was about $39. Yeah, there's just not. Most of the other equities in this retailers in this space have closed. JCPenney, you don't have a stock ticker. Sears, you don't have a stock ticker. Target's actually done pretty well, but they again pivoted quite successfully towards being a pretty strong competitor to Amazon, in fact, right, where you can actually pick up stuff in their online offerings are quite oriented around the Amazon kind of customer. GameStop was none of these things, which was why, if we look at it from 5 years ago and we start to try to look at what that share price was, that what June, July of last year, share price was about 4 something a share. If we take it back further to the beginning of the pandemic, we would see that the share price was, again, it's going to be quite low here. Well, it's probably going to be the 52-week low, if anything. For the 52-week low, we've got about $2.57. So at some point, probably in March, it was about $2.57. So what happened? Why is it today 225? And that's actually quite low because today it's down 30%. At one point, it was as high as, in the past few weeks, $483 a share. How does a stock that's in a dying business, that has, just looking at some of the other data here, loses money, loses about $4 a share. That's its EPS. I mean, it's a. I mean, what's the nicest thing I could say about it? What is the nicest thing I could say about this stock? At least it still has some cash on hand. It has about $400 million of cash on hand. Doesn't pay a dividend. It's very difficult for me to find something nice to say. But because of that lack of me being able to nice something to say, I'm not the only one who thinks that. Because what happened in early January is someone had I'd say the pretty smart idea of saying, what are the most shorted stocks out there? Now, let's talk about what it means to short a stock. When you short a stock, it's the opposite. When you buy a stock, you're usually saying, oh, I think the price is going to go higher in the future. That's why I'm going to buy it now at a low price and then sell it later at a higher price. When you short a stock, you're doing the opposite. When you short a stock, instead of buying a stock, you're borrowing a stock. You're borrowing a stock from someone who already owns it, like a broker. So you're borrowing a stock and you're going to sell it the moment you've borrowed it. And you're going to sell it at the current price. So if I wanted to short GameStop right now, what I would be doing is I would be borrowing it from someone who already owns it. And the moment it is lent to me, I would sell it. And I would sell it at $2.25 a share. The idea is that I'm going to pocket that $225, and then whatever I make the arrangements for with that loan, when I pay it back, right? When I pay it back, I'm going to have to go and buy the stock. And my hope and expectation is that the price is going to be lower. Meaning, if it falls down to $100, I borrowed it and got $225. It's only going to take me $100 to buy the stock back and give it back to the original broker. So when you short a stock, you're hoping that it's going to fall, and you're basically going to pocket the difference. So with GameStop, people said, wow, there's a lot of short going on. And it was. I mean, nearly 90% of the stock was shorted at some point, even in the middle of January. So 90 million shares. for a stock that had issued 69.75 million shares. So there were 69 million shares outstanding, 68 million were shorted. So almost everyone that was owning it had shorted it. That was the only reason why people were buying it. So the price kept falling and falling and falling. Someone then posted on Reddit, hey, all these hedge funds have shorted this stock in an attempt for them to make a lot of money. Hedge funds are like investment vehicles that are used to basically buy things that the typical person wouldn't buy. So things like timber and real estate and private equity firms and um, short stocks, reverse swaps. They buy mortgage-backed securities. They buy things that you and I typically would not buy. And that there was this hedge fund in particular called Melvin Capital, whose investment strategy was to short GameStop. That was how they were going to make their money. They were overly shorted of the stock. And basically, all these people got on Reddit and said, dude, if we all get together and start buying this stock, the stock price will not fall. And if it doesn't fall, then what's going to happen is that the company that did short it, Melvin Capital, is all of a sudden going to have to buy the shares at a much higher price because they're the ones that shorted it. Let's give you an example here. So I'm picking on them, but only because they are the actors in this case. So Melvin Capital. You can look it up. They ended up having to declare basically bankruptcy because of this. That on ticker symbol GME, GameStop, they had bet that it was going to short. Who knows what the current price was $5. They shorted it, and ideally, the intent was that it would be less than $5. So that's what Melvin Capital was going to do. Is they were going to short it. And the intent, the hope was going to be less than $5. The idea was, let's buy it. Doing so would then raise the price. Now here's the kicker. This started a short squeeze. What that is the short squeeze happens when Melvin Capital had said, let's say 90 days later, they have to return that share that they borrowed of GameStop. So 90 days later, they have to now buy GameStop because they have to return it. But now they had bought, they had received $5 for each share they borrowed, let's say. But now they were having to buy it at the current price. I don't know, let's just put it only was there briefly, but let's say it was $400. So now they're losing $395 per share. Let's see if I can get a good sense of like who the biggest holders were. No, I can't even really get a good sense. Anyway, um, Melvin Capital eventually had to go bankrupt. They didn't have enough money. In fact, they lost. I think they had a rate of return just for the month of January alone of losing 50%. Now, the difficult part to wrap your head around is how does this it's illegal. There's nothing illegal about what was all described here. It's what the big boys do, right? And I don't mean that um, in some weird classic sense of, well, it still is primarily men that are in this industry, but it's what the people in the industry do to make money is that they short things. The most, there was Herbalife was about 2 or 3 years ago, was kind of a more institutional example of what was going on here. But it does cause weird things to happen in the market, like GameStop increasing. I don't even know what percent that would be, like 700%, 800. I mean, I don't even know what that would be. It's yeah, I don't even quite a bit. I don't know how else to say it. Now, the reason why that causes a problem is because the stock eventually will have to go back down to where its fundamental value is. Right now, it's being propped up by the fact that there's all this manipulated or encouraged buying of the stock. And eventually, at some point, you're going to run out of buyers. The people that got involved in this are not going to be able to keep buying the stock and keep it up at that price. Because I guarantee you right now, there are people that are starting to short the stock again, and rightfully so, because it does not have a fundamental value as high as 225 a share. And so this is going to fall back to less than $5. And certainly today it was down $100. Even in the aftermarkets, it's down another $10, so 4%, and it's going to keep falling. There might be some days where it increases a little bit, but it's pretty much stopped. Now, it turns out, though, that one of the other kind of actors that's hurt in this whole thing is Robinhood. Many of you probably already even have a Robinhood account. So Robinhood, it's an app you download to your phone, lets you trade stocks for free. They're making money in different ways outside of commissions, but you and I, we can trade our stocks for free using that site. But Robinhood also then had to start restricting purchases of the stock, and they had to because they were worried about what the financial consequences would be for them. So it turns out then, right, if you're denied being able to buy it, that's going to make you less willing to use Robinhood to buy your shares. So it actually turns out that who loses? Well, Robinhood, the equity purchasing, stock um, purchasing app, can be hurt because people might stop trusting Robinhood for deals, because there's other free stock buying apps out there like Webull and whatnot. So what's next? Well, it looks like there's other stocks out there that people are now shorting as well. AMC, the movie theater, the one big one today is, I'm not making this a stock tip class here, but silver. People are thinking, and it's up 8% today, which is a lot for silver. Silver is now at I think this is going to be beyond a 5-year high. Yeah. I think it's like an 8-year high right now. 26.76 a share. Whereas I don't know what that lowest price was, but it looks pretty darn low to me. Um, $10.86. So you get a butter for $10.86 probably back in last March. And today you've now tripled your assets, which is a lot for a commodity that has no growth because it's just a metal sitting around. This is what the Reddit crowd's into next. Silver. This one's a little harder because the hedge funds, the ones that they made the money from for GameStop, not a lot of people short silver. Most people actually own it rather than short it. Um, I think what they're trying to do here, if I had to theorize what people are trying to do here, is that iShares, the company, needs to buy the silver that they have ownership over. So if enough people keep buying it, then iShares will have to go out and actually buy the silver, which would then increase the price even further. It's an ingenious idea. But the problem would be is that you're going to run into a problem because it's really screwing up the mechanics of the market. And this would be the point where generally regulators get involved. Okay, so I hope that gives you a little bit of perspective and understanding of what's happening in the market these days. I think the broader question is how much do we have to what extent do we have a bubble out there in some form, and that will be a topic for a different week.